Welcome to Modern Day Economics, where we discuss economic issues and events that directly affect our families and communities. Today, we're going to talk a little bit more about mortgage rates and what's going on with mortgage rates, which directly affect the cost of purchasing a home on a monthly basis and the real estate market overall. Economic data came out mid last week that shows that mortgage rates increased to 5.82%. Now, it is important to consider that not too long ago, you could get a mortgage for even lower than 3%. So, the impact that this has on a monthly payment on a mortgage is very, very drastic. The increase in rates can put a downward pressure on demand and could very likely be one of the reasons why this is happening, there is currently a decline in home sales. So, this is all in context of expectations next week of rates being risen. The Fed funds rate that the Federal Reserve is predicted to raise. Now, how will this affect mortgage rates? So, mortgage rates are not directly tied to Fed funds because banks, for the majority of mortgages, at least for mortgages that are sold to Fannie Mae and Freddie Mac, they don't necessarily hold the mortgages till maturity for the 30 years or 20 years or whatever term that the mortgage itself is. So, although there is, of course, a correlation, all rates are correlated in a way to Fed funds. There is a supply and demand component from the market of mortgage backed securities. Um, Mortgages are sold to Fannie Mae and Freddie Mac and then compiled into mortgage backed securities that are then sold into the market. Now, if it is true that the government has purchased these in the past and they were to offload their position, therefore decreasing by default the demand of mortgage backed securities, could this have an effect on rates? Possibly. It is a possibility. There is no guarantee in the markets and in economics, as we all know. It's all a balance of probabilities. But what we do know is that if it is up to private investors and they are taking on lending at a relatively low rate, which is under the rate of inflation, they may command a higher risk premium. This may be a reality. So, as we continue to see inflation, if inflation is not contained, we could see mortgage rates going up relatively significantly. This is a real possibility that could inflict some downward pressure on demand in the home purchasing market. So we will have to see. We will have to see this week what happens when the Fed meets and they decide to raise rates potentially, if they do decide to do so, and if this has a direct effect over the mortgage rates. Now, there's a lot of talk in the real estate industry about there being a supply shortage, and this may be true, but with anything that there is a shortage of supply, you can decrease demand enough to the point where supply starts to build up. As little supply as there may be, if there gets to a point where there is no demand, eventually, just by the nature of people moving, by the people that in a regular situation need to sell their home, not necessarily because it's gone up in price and they want to capture that equity, but because they need to sell their home to move to a job relocation, they need to sell their home for any other reason other than equity capture. There is going to gradually be more homes on the market potentially. This is a possibility um, if rates go up significantly. If that were to occur, so definitely something to at least look out for. Again, we don't make recommendations. This is not financial or professional advice in any way, shape, or form. But certainly something to keep an eye on that is very interesting to say the least. Thank you for tuning in to Modern Day Economics. Stay tuned for more economic news and events.